With another bull run potentially kicking off, we want to make sure to go over a couple terms, some simple ways of how to read the charts. Things like the differences between a bull market and a bear market, and why we like to use candlesticks instead of line charts so that we can see a better idea of momentum, to have a clear picture of who's in control, be it the bears or be it the bulls at any moment. As shown here in our trade, we started yelling that it was a bull run back at 3,500 when COVID hit. After COVID, when we topped out at 69K, we called for that bear market dump to 16K. And now that we've hit it, we are looking for 4 things to validate this trade and this breakout. The original trade setup calls for some sort of pullback here or consolidation. Whether or not we get it is yet to be seen. This could happen in a few ways. We could just get some consolidation with a range trading up and down as like this red line, or it could just roll over and dump. All that really matters is it stays above the white dotted line. And while we're waiting to see what price does, we could look for the 20 MA to give us a pretty good signal of where it's going. This moving average generally dictates both bears and bull markets. The breaking of it to the upside at the end of a bear market generally and historically has always signaled the bull market. When we lose that line and fail to get above it, just like last time, that always signals the bear market and the bleeding of crypto. And now with the breaking of that moving average, we move on to our next validation, which was to break this wedge. So to get a measured move in a target, you go from the swing low of the pattern to the swing high. And if you move that to where the breakout point is, that should give you your target of where to sell and take some profits. Here you see 100K. Our only box left to check is volume. We want to show that volume is going to continue to increase. So these green bars, we want to see set a higher high. So we go ahead and mark them here. So with that in mind, that we're not completely validated, we better leave ourselves some room to be wrong. That's where the hedges come in. A hedge is a bet against your original long that price may fall. So by taking shorts here, we aim to make gains that will cancel out any losses we could incur if we were wrong. So basically, we're hoping to lose the 30% risk here we have on our hedge short, because it would mean that our long gains would be huge compared to that. This is never advice, just the rantings of a madman.